Okay, guys, stocks are back up again. Everything is rip-roaring to go. Nothing to worry about, correct? Guys, it was said recently by some great investors that complacency is very high. What they mean by that is to see, this is from Jamie Dimon actually, to see stocks fall 10% and the rebound 10% like that, you might sit there and say, well, that's great. Yeah, maybe. Or it's complacency that people just believe that when stocks fall, they just come right back up again. Is that real? I mean, yeah, it could be real. And I asked the question of, okay, what does the future look like where every single time stocks fall 10%, they rebound just like that? I think this is a long 16-year bull market we've been on, and it's been absolutely incredible. And we don't know what's going to happen in the next few months, years, anything like that. What we do know is where we stand on valuations. If you're new to watching this channel, you will see that I truly believe that in the long run, stocks are a weighing machine. What that means is valuations and fundamentals will drive the market forward. So if you pay a ton of money, though, today for future growth that hasn't occurred yet, you're probably going to lose out on gains in the long run. Now, that doesn't mean go sell everything. It just means be ready for that. Understand that valuations drive markets in the long run. So when that happens, as markets start to fall, you need to be dollar cost averaging. So where do we stand in terms of valuations? Well, guys, stock market to GDP ratio is the single most reliable metric going forward, according to Warren Buffett. This is an intensely strong inverse correlation. The higher valuations are, the lower the returns are in the next 10 years. That's what I ran here. I sat there and went back to 1928 on stock market to GDP valuations, going all the way back, and ran a correlation, and that's negative 0.8. Negative 0.8. That's a very strong inverse. I'm not going to get you into the math of it and all that stuff, because I actually don't know how they do the math. It's called Excel. But what this means is correlations go from negative 1 to 1, with 0 being in the middle. 1 means that if something goes up 1%, the corresponding item goes up 1%. 0 means there's no correlation, and the opposite is for negative 1. If one thing goes up 1, the other thing that's correlated to it negatively goes down by negative 1. This is a negative 0.8. Guys, we are 109% overvalued here. 109% overvalued on this metric. Now, people argue about why GDP doesn't matter because we make so much money abroad, blah, 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 blah. It's whatever we need to say and feel to make it feel like it will be different this time. That's what people are saying here. Because when you go to stock market, the 10-year PE ratio, which is just caring about the S&P's profit, doesn't matter where it's earned, we're actually 111% overvalued. We're actually worse. Now, this one's not as correlated. It's not as strong a correlation. It's actually a lot weaker, but it's still a negative correlation. But I look at this going, so what does this mean? It means the next 5 or 10 years is not going to be as good as the last 5 or 10 years. And that's okay, because you can still make a lot of money in the long run with markets going flat. Because as values go like this, prices go like this. We're probably somewhere in here. And there'll be times when we're down here, and as long as you're dollar cost averaging along the way, you will make this return in the long run. And that's good. As the U.S. economy gets bigger, as the world economy gets bigger, stocks in those markets will go up, because that's just what happens. Because as companies get bigger, as they make more money relative to GDP, they will go up. Now, we are coming off of very, very bad valuations. I don't think the next 5 or 10 years is going to be that great. I don't know what's going to happen in the short run, but it'll be a great test for you going forward. What happened today that caused the market to go down? Now the Nasdaq's back up. S&P and Dow are down slightly, 0.34 and 0.84. Well, people are worried about interest rates and yields went up, and it's all the blah, blah, blah. Guys, yields are great. You should be happy that yields are up. You should want higher interest rates. Now, that's going to be very counterintuitive to what you've heard, but you should want higher interest rates. And the reason being is higher interest rates makes it hard for speculators to make money. But you're not a speculator. You're an investor. What does that mean? It means that you understand what drives returns. Fundamentals getting better. Low prices relative to what you're buying. Your job should be to buy when values are here and prices are here. If you can do that, you will do very well. It's hard to do that. Why? Well, because in order for prices to fall far below value, there has to be a story attached to that. and we all learn, we all believe stories. The best way to sell something to somebody is with a story, a fearful story. Here's what happened. So the story on Meta, when it was $88 a share, was Zuckerberg's an idiot. Nobody uses Facebook anymore, blah, 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 blah. And we sat there and said, but wait a second. User growth is up. They have WhatsApp, Instagram. Their revenues are going up. Profit is going up. What's going on here? Now, that's an anecdote, but there's several anecdotes a lot like that. Same with on companies like Tattooed Chef, Workhorse, all the companies we told you guys in our main channel to avoid years ago, saying, we don't get these. Guess what they went to? They went to zero. Why? It just didn't make sense. And we're like, okay, the same thing that doesn't make sense when it's low, another company cannot make sense when it's high. That's what investors do. Investors realize that there is too high a price to pay for a good story, because our fifth tenet of our principle-driven investing is a great idea at the wrong price makes a bad investment. Now, something I want to talk about United Health. This is a very, very interesting story that's going on. But before I get into that, guys, we made these channels and we have 7 or 8 businesses upstairs. Our goal was to teach people. Our main goal is to teach people who have an interest in being like-minded. If you're a speculator, if you're somebody who sits there and listens to a story and buys a stock because it's going up, not because valuations are getting better, we're not the channel for you. And I'm okay with that. There are plenty of other idiots on YouTube out there who think that way. Follow them. But if you're really trying to understand why stocks go up in the long run, how you should evaluate companies, how you should look at the markets, we're the channel for you. We want like-minded people. This software was built for like-minded people. We have thousands of users in the software that use our tools, that use our software, use our data to sit there and make better and informed decisions. And on top of that, they have this community of people, thousands of like-minded investors to talk to. Now, we're not here to sit there and get anybody and everybody to join our community. That is not our goal. Our goal is to get a select few like-minded people who want to learn and get better. Listen, a lot of people out there don't want to learn and get better. They say they do. Everybody sits there and says, I want to get better. I want to get better. I want to learn. Okay, cool. Here's why NVIDIA is overpriced. No, you're an idiot. Okay, sounds good. Like, this is why I think NVIDIA is overpriced, because I think it's pricing in a lot of great things in the future. But if you feel like you want to be more of a Warren Buffett type investor, more of a thinker, more of somebody who understands things, we're the place for you. I highly encourage you, check out our community. We're running a great special, $7 for 7 days. But really, I truly, truly mean this. Do not come to our community if you're just looking for stock tips that you can make short-term money on. If that's what you're looking for, we're not for you. Do me a favor, block our channel. And I'm not kidding about that. The YouTube algorithm works very, very well when we get like-minded people to watch our videos. That's what we want. Those are the only people. We want those people in our community. We want those people watching our videos. Now, United Health. Guys, this is an incredible story. What a year for United Health. The assassination, essentially, of their CEO. Incredible, right? Now, there's allegations. They've fallen 50% in the last 6 months. This is an incredible drop, 48% in the last 6 months. An incredible drop. All-time high in November of last year of 630. They're now at 307. Hit a low of 248 just last week. So, guys, in the last week, it went from 248 to 307. Guys, there's allegations of Medicare fraud. That's huge. That is 55% of their business. Now, why do I bring this up? Well, I texted my group and said, guys, should we be looking at United Health? Remember, things are best when things are scariest. It doesn't mean you should buy United Health, but I do believe you should take a look at United Health. We're going to take a look at United Health. 9 times out of 10, this is probably a really bad idea, and the juice ain't worth the squeeze. But the question is, you have to understand the case. What is the case against them? How likely is it for that to actually come to fruition where they lose all abilities to do Medicare and Medicaid and all those things? I don't know. But that's what investors think about. Investors look at this and say, okay, what's the story? How true is this story? That's the lesson to be learned here. I don't know if it's true or not. It probably is true. But it's about understanding. Remember one thing. You ever roll a dice here? A die has 6 sides to it, 1 out of 6. So your chance of rolling any number 1 through 6 is 1 out of 6. But what if I told you every time you hit a 2, I'm going to pay you 20 to 1? Think about that. So you have a 1 out of 6 chance of multiplying your money by 20. That means your probability is 3.3x. That means every time you roll the dice, you're going to make 3.3 times your money. You should do that all day long. But if I told you that 1 out of 6 chance of rolling the dice is going to get you a bullet to the head, right? You're going to be like, well, wait a second. That's what investing is. Investing is about sitting there and looking at your outcomes and saying, is this heavily in my favor? You could still end up being wrong. It could still end up being the one, because on United Health, you're either going to be wrong or you're right. It's not like you get 20 chances, but what we're trying to do is we're trying to tell you, hey, find 100 United Healths. Find 100 companies that are mispriced. That's what investing is. That's what we're trying to teach in this community. Yes, you could be that wrong that one time, but if you do it enough times, you'll make a lot of money. Remember, Warren Buffett and Charlie Munger have not hit home runs on every investment they make. In fact, they've written down investments to zero several times. The name of their company is Berkshire Hathaway. They said that's one of the worst investments they ever made. Think about that. But what they did right was they made the right investments at the right times, enough times where when they were right, it was huge. That's the big key here. That's what we're trying to teach in this community and on this channel. So again, check out the community, everythingmoney.com/sign up. Check it out. If it works for you, it's only $1 a day. If it doesn't work for you, more power to you. Thank you for your time.